how he trades today. Dividends are phenomenal. We're going to do that this afternoon. So we're going to cover dividends. Fundamentals is next. Right after this next section, we're going to get into fundamentals, which gives us the quality of a stock. ETFs, so we're going to cover 1, 2, these 3 today. Stacy's going to get into ETFs tomorrow. You're going to like that. ETFs are for those of you that have money in mutual funds. Well, we can convert those into exchange traded funds so you can start writing covered calls and bringing in your monthly cash flow on those. All right, so now the Buffett style. So this is the cash flow discount valuation model. It was created, it is the Warren Buffett, many people call it the Warren Buffett model, but this formulation is actually taught at every major financial university in the country. We are the only company, and there's many proprietary features on our toolbox, but we are the only company that actually has this automated, right? And what this tells us in a nutshell is the stock, you can see, is trading at 44.67, and the fair value. So what that tells us is if I can buy my stock at this price or less, then I'm buying the stock at a discount. I'm essentially getting the stock at a wholesale price. I'm getting a good discount. I'm not overpaying. So this gives us a good range of how do I get a very good value on my stock. So that's what the fair value tells us. And now what do we have? We've got using a business mentor, somebody like myself or like Stacy or like Mike, somebody who does this for a living. I do not want to learn how to trade from somebody who can just teach it well, right? Somebody who's read a book and can explain it. I want to see that what they're teaching me they're doing in their own accounts. That's what I want to see. So someone who does it for a living. As a matter of fact, think about this, and you don't have to write this down, but just think about this for a minute. Because many times I hear people say, I'm really smart, I think I can figure this out on my own. As a matter of fact, Mike was telling me recently, someone had said to him, because right now, you all have access to this toolbox, to our website for 60 days, okay, starting today. After today, after 60 days, it's $24.99 a month, so $25. And Mike was telling me that somebody had said to him, well, why do I want to pay you $25 a month when I can just recreate the same thing? And for me, I thought, wow, I've seen this website over the course of the last 15 years or so just expand and develop. And, the server alone is more than that. The data feeds from all the different exchanges is over $20,000 a month. So I just thought, okay, that person has the wrong mindset. What they're thinking about is building and creating and not how do I make money? Because what we're here to do is how do I make money? That's what we want to do. We want to make money. But ask yourself this question. How many people do I know that are financially independent, okay, so no other job, no other source of income, financially independent, because they taught stock market investing to themselves? Didn't take a class, didn't learn how to, just taught it to themselves. Now, what that means is if you took away all their money today, they had no source of income, you know what? They could still recreate their income because they have the skill of how to make money. Think about this. I know how to ride a bike. Take my bicycle away, I still know how to ride a bike. I don't need the bike to be able to ride a bike. I know how. It's a skill. And I'll tell you, I don't know anyone. I don't know anyone that has taught themselves how to trade by themselves and is financially independent, right? So everyone here does this for a living. So that's what they do. As a matter of fact, here is, one of the emails we got from Jim Pooler. Now, he was on the trading floor. So listen to this. Was on the floor for 30 years, did well. The last 5 years have flatlined small profits, can't seem to find the proper education, and wasted lots of time and money in pursuit to no avail. I reviewed your videos and was pretty amazed. Now, that part right there kind of astonished me, because when someone enrolls in our class, we will send out a pretty basic video just on getting them some comprehension on the market. And this was a basic video that's sent out in the very beginning, and he was amazed by the most basic video. Now, he was on the trading floor, right? And he knew how to do his job. He probably did his job very well, but he didn't know how to make money in the market. So that was pretty amazing to me. Would like to move slow, though, so which sign-up option would you suggest, Jim? Now, that was someone who worked in the field, was on the trading floor, knew how to do his job, but didn't know how to trade to make money. So, on-the-job training. Now, did you know that Warren Buffett's father, and I don't know if everyone knows this, when people say, how old was Warren Buffett when he first placed a trade? Warren Buffett is definitely considered the best trader, investor in our generation. Well, he actually had a mentor, Benjamin Graham. His father was a broker. He grew up in the field, didn't want to work for his father, wanted to work for Benjamin Graham, and actually went to school where Benjamin Graham taught just to learn from him. Now, he already knew how to trade. He'd been trading and learning since he was 12. Why did he do that? Because he wanted to learn from the best, right? He wanted to learn. So even Warren Buffett had a mentor. So when you think about people that are the best in their field, they have coaches, right? Now, why have a coach? You know, for example, basketball players, they have a coach. Professional basketball players, professional hockey players have a coach. Professional football players, professional tennis players, they all have a coach. And what is the purpose of having a coach? Well, the purpose is it allows you to practice perfectly. See, you don't want to just go out. I could go out tomorrow, go to a basketball court and just start shooting baskets and practicing. But is it possible to practice incorrectly? Absolutely. So I want to practice perfectly, right? I want to be able to practice perfectly. And that's what working with a mentor does, because it allows you to work with real money as you learn. What if instead of practicing on my own and doing it incorrectly, you sat right next to Stacy and practiced with her and was able to trade real money and followed along with her trades? So now it completely, and Mike as well, you can follow along with Mike or Stacy. And now you're working with us with real money, so it completely shortens your time from education to profitability, right? Now you're able to practice and learn and make money as you're learning. That's what a coach does. It just shortens it. So it shortens our time from education to profitability. And you know, why is that important? Why is it important to practice with Mike, with Stacy, to trade along with us? Because guess what? Here at IncomeTrader, we don't like to lose. And one of the things that we will teach you is if the trade goes against you, and you know what? Sometimes that happens. You can do everything perfectly right, and something will happen in the news, and all of a sudden the market changes. Now, what do people do? A lot of times they just say, well, sell at a loss. No, we don't like to do that. We will teach you how to turn that trade into a profit, how to change strategies. So if we don't like to lose, guess what? You're not going to lose because you're trading right along with us. That's why it's important to trade with people who do this for a living. Not people who can teach it, but people who actually are doing it live in their accounts right by your side. That's where that makes a difference. Okay, so flawed investment plan. Most people put their money into mutual funds, right? And guess what? The mutual fund has to go up. Not only does it have to go up, it has to go up faster than all the fees they're charging you. You know what? It doesn't always work out. Did you know that the majority of mutual funds actually don't make money? And Morningstar.com, and that's where you can find this, over 90%, and we'll talk about that a little later today, but most mutual funds are actually losing money. Here's the thing, you guys. It is so important for you to learn how to make money in an up, down, and sideways market, because the market's not always going to go up. For example, I mean, and some people are saying we're headed for a downtrending market. We're headed for a reversal. So what if I went onto our toolbox right now, I went onto our website, and I just said, okay, let me get onto the website here. And so I get onto the website. I'm going to have to log back in here. So, and when I'm on the website, I just come to the top here where it says scanner. And let's say I think the market's about to go down. Well, I have several options, and we'll get into searches a little later today, but what I can do right away is I can say, okay, let me find 3 red arrow search. Okay, so what that's going to tell me, now there's the downside breakout search, there's bad stock, there's several searches, but here's 3 red arrow search. Click on 3 red arrow search, and it's going to tell me all the stocks that as of last night got, and I'm going to teach you what those arrows mean and fundamentals today. But this is going to tell me right now stocks that are heading down. So if I just look at this first one here, and this is LQD. All right, so let me click on that. Now, what if I wanted to, and you want to know the difference between real estate and the stock market. So the difference is this. In the stock market, I don't care which direction it goes, right? In the stock market, I can make money if it's going down or if the market is sideways or if it's going up. Whereas in real estate, I'm going to make most of my money when it's going up. Stock market, it's actually the exact opposite. I mean, I love a sideways market, and Stacy's going to show you an amazing way tomorrow with a cash spread to make money in a sideways market. But it's in a down market that you can actually make most money. But there's many ways to do this. All right, so let's say we look at this, and I can see here that I've got some lower lows and lower highs, and it's just broken through some support. And this is trading right now at $129.76, $129. That's what it's trading at. Now, did you know that, and let's see something, this is a bad stock as well. So it's a bad stock, and it's in a downtrend. Did you know that I could go in and I could actually sell this stock right here, $129, I could sell it, and maybe I sell 500 shares or 1,000 shares of this stock. Now, I don't own this stock. I don't own this stock at all. I don't want to own a bad stock that's heading down. But I could sell that stock today. And when you sell something, money comes into your account. Now, I know this is new for a lot of you, but I just want you to understand what's possible here. So let's say that I look at this and I say, okay, I'm going to sell, 1,000 shares. Okay, I sell 1,000 shares. Now, 100, now the minute I do that, I hit sell. I go in, and I'm going to show you how to do this later, where I have a choice to buy or sell. And I hit sell. Do you know if I say I'm going to sell 1,000 shares of the stock? Now, I don't have the stock. I don't own the stock. It's not in my account, but I can hit sell, and 1,000 shares, so $129,000 will come into my account. Now, the first thing you're saying is, that can't be true. How is that even possible? That doesn't even make sense. Well, the answer is, how do you sell something you don't even own? Well, the simple answer is, in the stock market, you can. There's really no rule that says you can't. So I'm going to sell 1,000 shares of that stock. Now, what the market maker is going to do is they're not going to actually go and buy the stock. They're going to just deposit that money into my account, but they're going to go to somebody else who has bought this, and they're in it for the long haul, because that's what they've been taught, which is ridiculous, because you're not in an investment or a stock for the long haul. What are you in for? Think about that. When you buy a stock, what are you buying it for? To make a profit, right? That's what you're in it for. But we've all been taught we're in it for the long haul. So they will actually go over, let's say Stacy has this. She's got shares in her stock. She's not selling it. She's in it for the long haul. So she has that. And she doesn't sell it, so they go into her account, they take the 1,000 shares, put it into my account. Now, I know this is a new concept, but why are they going to do this? Once again, we talked about this earlier. How many of you have got bank loans? Why does the bank take money from someone else and put that money, when you borrow money, why are they taking money from someone else's account and putting it in your account? Because you're going to pay them interest. And the brokerage firm is going to charge me, about 5% interest. Now, what's going to happen? I've got 1,000 shares of the stock in my account, and it's going down. And let's say in the next, 30 or 60 days, it goes from 129 down to 125. And when it hits 125, I go in and I say buy. And I buy 1,000 shares of 125. Well, now what the brokerage firm will do is they will automatically take those shares, because now I bought them, and go put them back in Stacy's account. I just made $4,000. $4,000 on a stock I didn't own. And now, did the brokerage firm charge me interest? Yeah, about 5% a year. That's not very much, considering I just made $4,000 in about 60 days. Now, that is just, my point is, and that's something you can do. There's also other ways, other option ways to make money. There's about 5 or 6 ways to make money when a stock is going down. Ways that are actually very conservative with very little risk. There's ways with very little risk. Now, this strategy has a little more risk. Stacy's going to show you a strategy tomorrow that has very little risk, where you can also make money as the market goes down. But my point is, we must learn to trade every direction. We've got to learn how to trade, because you know what? The market is not always going to go up. It's going to go down sometimes, so we have to be able to trade every direction. All right, so trade every direction. And in order to be able to do that, you're going to have to learn to read a chart. And we're going to get into reading a chart, and that'll probably be about an hour and a half or so before lunch, maybe a little after lunch. So we're going to do that. But how do we know when to get in, when to get out? It's from our technical analysis. All right, so now we're going to learn about leverage. How do we use leverage in the market? We've all been taught leverage. What most of us have been taught is, think about it. We know leverage in real estate. In real estate, you make 7 or 8% a year. I don't want to make 7 or 8% a year. In the market, I can learn how to make 7 or 8% a month on my invested money. That's what I'm after. I'm not after 7 or 8% a year. I want 7 or 8% a month on my invested money. So in real estate, we know about leverage, right? You go out and you buy a house. Stock market, there's leverage in the stock market as well. In business, we know leverage in business. Banks use leverage all the time. You take loans out. So we're familiar with leverage in real estate and in business, but we haven't learned how to use leverage properly in the market. It just hasn't been taught to us. So we're going to show you the conservative way to use leverage properly to actually mitigate risk and get higher returns. That's what we're after here. So let's say, and this is just kind of because most people aren't familiar with leverage, so I want to get you a little more comfortable with leverage in the market. We're familiar with leverage everywhere else. We're just not familiar with it in the market. So here's a great question for you. If you could go to the bank tomorrow and borrow $200,000 for an investment with a warehouse with no money down. Now, can you find loans with no money down? Yeah. Is it simple? No, not always, but this is just an example. All right. So this is just a thought exercise for you. And one thing that the market is really good for that I like, because I invest in real estate, as I said, so does Stacy and Mike, is what's wonderful in the market is you can have your principal, your money, and do trades each month and grow that principal and take the money that you've grown from that principal and invest in real estate. All right. What's nice is you still have the principal, because oftentimes in real estate, you save, go and buy that piece of property, and now you're asset rich but cash poor. Now, the stock market allows you to grow that principal, kind of grow it, and then invest in real estate and still keep your principal. So that's nice. So now, if you could go to the bank tomorrow and borrow $200,000 for an investment in a warehouse, no money down, you have a $1,400 a month payment. Now that's principal, insurance, interest, all in, $1,400 a month. But you already have a renter wanting to rent or lease that warehouse for $2,000 a month. Now, they actually want to do it for 5 or 6 years, but you might raise the rents. You don't want to necessarily do it for that long, but they'll do a 3-year lease. Would you do it? Now, the answer, of course, is absolutely yes. And why would you do it? because you're going to immediately get $600 of positive cash flow. Now, you could take that money and set it aside in case the renter, leaves or it's vacant, or you could spend that money, reinvest that money. But the bottom line is you would do it because of the positive cash flow. Now, I don't want you to spend too much time thinking about the deal, because this is just a deal. But what I want you to understand is think about the mindset behind it, because it doesn't matter that you're borrowing $200,000. That doesn't matter. The cost doesn't matter. What matters is the return. See, not just in real estate, but in life, you want to focus on not the cost. I don't care what the cost is if there's a profit. As long as I have a profit, right? The cost is always going to be part of any deal, part of anything in life. We're not focused on the cost, we're focused on the return. And that is a shift in mindset. What is my return on my investment? Is there a profit? Now, if there's a profit, now I can evaluate the deal. Doesn't mean I'm going to do the deal, but I can at least move to, okay, this is a deal that makes a profit. Let me now dig further and really evaluate that. So that's kind of a mindset piece that I want to go to. And then ultimately, we're going to have to reposition our funds. So many of you have money in mutual funds. We might want to, and Stacy will talk about that. And you can talk with your coaches about that too, but we want to reposition some of those funds and move them around so that you can start trading and getting some of that monthly income. So that's the last piece of it. So now let's jump into, and don't worry about kind of where that whole mindset piece went. I just wanted you to really understand our focus, because you're going to learn strategies. I'm going to show you different strategies on one stock. Now, some of those strategies might have higher return, but maybe a little more risk. So you're just going to have to, I can't tell you what is right or wrong for you. You know how you want to trade, but there's many, many ways to make money in this. So now let's get into fundamental analysis. Now, fundamental analysis is really us looking at the quality of the stock, all right? Once again, this is all for educational purposes. So, Benjamin Graham. And once again, who is Benjamin Graham? Warren? It's Stacy's mentor. Yes, she calls him all the time. No, Benjamin Graham was Warren Buffett's mentor. Warren Buffett, all right? And what he said is the reason to own a stock is that you want to become a partner in a great business. Now, as we go into fundamental analysis, all right, as we jump into this, what we're looking at is the quality of a stock, the quality. So you don't want to just buy a stock because it's there. I want a stock that is good quality, a stock that's growing in earnings, growing in profits, doesn't have much debt, expected to do better next year than this year. So we're going to look at all of those facets right now. How do we evaluate? How is it being managed? Is it profitable? That's what we want to look at first. Now, this isn't the technicals. And technicals is my favorite. Technicals is when to get in, when to get out. But we're not doing that yet because we first need to know, is this even a stock we'd want to buy? So that's where fundamentals comes in. So when we are looking at buying a stock, and if we're going to write covered calls, which is what this class is about, we want to buy a stock, and we want to buy a good quality stock. We don't want to buy a bad stock that's going to receive bad news. So, for example, a good stock, less likely to receive bad news. As I said, if I'm going to write a covered call, it's very similar to renting a house. Now, once again, everything that you need for writing a covered call is in this class. And like I said before, we have many other classes. And some of you are going to want to take some of those other classes, either because you want higher rates of return or, quitting your job tomorrow, any of that. But for right now, for covered calls, everything for covered calls is here. And for covered calls, we want to, one, buy the stock, and we want it to be a good quality. If it's a bad stock, one that's got bad news, one that's losing in earnings, losing in profits, doing worse and worse in a downtrend, nobody wants to own that stock. They're going to sell that stock, and that stock's going to go down. So good quality stock. Now, is there different ways to buy a stock? Well, think about buying a house. It's like buying a house, right? Now, is there different ways to buy a house? Yeah, I can go and buy the house, or I could maybe do a lease option to buy. And what if I did a lease option to buy and then put a renter in? And what if my payment was less than what I'm renting it for? Well, now I've bought a house in a different format and I'm bringing positive cash flow. But for right now, forget that. We're just going to buy a good quality stock. We're going to buy the house first. We're buying the house and we're renting it out. So good quality stock. It has better chances for growth. So, a bad stock, as I said, one that has bad news, one that's losing money, has lots of debt, no cash in the bank. People are going to sell that stock. It's going to go down. I don't want to own that stock. I don't want to rent that stock out because I'm going to lose money. I want a good quality stock, right? Now, when I say good quality stock right now, I'm speaking, think of it like, when you're inspecting a house, right? You just want to make sure, and we'll talk about that in a moment, but just a good quality. So, volatile. Does anyone know what volatile means? Volatile? Volatile. Now, volatility is actually good, and volatile stocks, there's some great ways to make, you're going to want to learn about volatile stocks only because volatile stocks have really, really high returns, and they actually are great for cash flow. So they're great for monthly returns. They're great for cash flow. There's some other classes you'll take for that, but volatile essentially means all over the place. Up, down, all over the place. Volatile. A lot of people say redheads are volatile, so I've heard. I don't know though, right? All right. So bad stocks are difficult to trade. So covered calls. Now, bad stocks, if they have a sustained selling period and they're going down, writing covered calls, we're still losing money. All right. So when I say good quality, bad quality, once again, I'm talking about the quality of the stock. We're not at technicals yet. Technicals is next. Technicals tells us when to get in, but we have to know it's a stock we want to buy. Okay. So much like evaluating a house, think of it like going into and getting an inspection, and they come in and they say, how's the plumbing? How's the foundation? Is there dry rot? Oh my gosh, there's rodents. Oh, I see termites. Things when I have a home in Washington, I have a home in Florida, and so I kind of live bi-coastal. But when I am looking at a home, the first thing I do, and it's interesting because homes in Seattle are built entirely different than homes in Florida. Homes in Florida are not built with wood like Seattle because guess what? When hurricanes come, they're not going to be around. So whenever we do an inspection, and that's what we're doing now with our stocks, is we're doing an inspection and saying, what is the quality of this company? We're going behind the scenes. We're going underneath the house, right? We're going in the attic. We're going into this company underneath, things that you wouldn't see necessarily just cosmetically, not with curbside appeal. All right. So we're going to take out all the emotion and just take a look at the numbers. So we have valuation and growth. So there's value stocks and growth stocks. Okay. So what is the difference? A value stock is a company that's been around forever and it is not going anywhere. So think about products we use every day and we're going to always use them. So toothpaste, toilet paper, electricity, things that are not going anywhere. There's not going to be some invented, oh my gosh, here's the new and improved paperless toilet paper. That's not happening, right? But they're going to be around forever. Now, growth stocks are companies that are rather new. A lot of technology stocks are growth stocks. For example, so think about, Facebook, Google, companies that are growing fast, but they don't have a history. They don't have that long history. So you have value, you have growth. Now, if I'm close to retirement, I'm probably going to stick to a lot of the value stocks. They typically pay a very good dividend. And you're going to love dividends because it's just another way to make money and you don't have to do anything at all. And that's going to be after lunch today. So we're going to do a whole section on that, and that you will absolutely love. So we have value and we have growth. Now, when we first went through this, I didn't like any of this. I just wanted to make money. And I love technicals, okay? And you don't want to take as many classes as you can on technicals. The more you learn how to read a chart, the more money you're going to make. But what's nice about this is it is all automated. But, for me, this was like, oh my gosh, numbers. I just want to learn how to read a chart, how to get in, and how to make money. That's all I wanted. And that's more technicals. But we can't get to there until we know it's a good quality stock. So we're going to go through all of these items. Now for this section, and I've been on the PowerPoint quite a bit. Now moving forward, I'm really going to be on the website. So this whole segment, I want to go live to the website because you're going to pay more attention if we're live on the website. So go ahead and type in a stock, and the first one that's typed in is the one we'll look at. And we'll go through all of these, the valuation, the PE, the price. I'm going to go through all of these with you, but we're going to do it live on, and then we'll look at many of your stocks too. So we're going to kind of look at a lot of those. So go ahead and they will tell me the first stock that's typed in, that's the one we'll look at. So right over here on the left-hand side is where I can put in a ticker symbol. And if you don't know the ticker symbol of your stock, there is a symbol lookup that we can look it at, but we know because this is what we do for a living. So do we have one yet?
We do. The first one came up is XLB.
XLB.
That's an ETF.
Oh, that's an exchange traded fund. Oh, Apple. Okay. Apple. So here we go with Apple. Let's look at Apple. Now, when I first pull this up, so we'll come to the chart later, but let's just look at the quality. Now, right away, I can see here, and the nicest thing about this website is, one, it was made by an investor for investing. So there's no junk on the site. Everything there has a very specific reason, and it's placed in a very specific order. So right when you log on, this is nice. Oh, thank you. I just saw that as well. Right when you log on, you can see that Apple is in the computer office industry, and it's the computer technology sector. So when we first log on, we're going to go through all of these. So all of these, there's 17. We're going to go through every single one of these, and I'm going to kind of explain what they are. So the first thing that we see is PE ratio. PE. Now, this is the most important thing aside from net profit. So this is the second most important thing, which is PE ratio. And PE ratio, most people don't even know what a PE ratio is. And what a PE ratio is its price divided by earnings. That's what it is. And what it tells us is if I were to buy the stock right now today, how long would it take me to get a return on my money, make my money back with the current growth and profit that the stock is having right now? So price divided by earnings. Now, let's think about real estate for a second. If I was going to buy a house, and let's say the house is $550,000. Okay, well, is that a good price? Well, I don't know. How do I know if it's a good price? Oh, I have to compare it to all the other houses in the neighborhood, right? So price divided by earnings, we're going to compare that. Now, notice right next to price divided by earnings, we have TTM. TTM. What does that stand for? TTM. It does not stand for TTM. No. It is trailing 12 months. Okay, so that's a trailing 12 months. And now I've got my price divided by earnings for the trailing 12 months. So what is my number? My number is 37.13. 37.13. Well, is that a good number? Now, let me ask you this. If you were going to buy a stock, would you want the price to be high and the earnings to be high? Or would you want the price to be low and the earnings to be high, and just with the understanding that the price would eventually go up as the earnings went up? Yes, you want the price to be low on your price per earnings, your PE. So what is our price? 37.13. Now, how do I know if that is a good price? How do I know? Well, once again, I have to compare it. Yeah, I am. I have to compare it to all the other stocks in that same industry, just like I'd compare it to all the other houses in my neighborhood. So I look at this one, and right now I'm going to compare it to the same industry. So what about all the other companies in that industry? Well, their number is 25.35. So it takes, on average, for that company, it would take an average of 25 years to get my money back versus 37. Well, which do I like better? I like 25 better. So Apple does not do as well as its industry. Now, let's now look at the sector. So think of the sector like the whole city. Okay, so we looked at our house and we compared it to the neighborhood. Now we're going to look at our house, compare it to the city. So now we're going to compare it to the sector. Okay, it's in the computer sector. So the sector, it's 32. So now that means that it would only take 32 years. So guess what? Apple is not doing well in the city or the sector. So notice that this is in red. If Apple was outperforming, if my stock was outperforming the city and the sector, these would be green, okay? So now we're going to compare it to the entire industry. We're going to compare it to the S&P 500. And the S&P 500 is 23.25. So it's also lower than Apple. Now, here's what's cool about this. Do you realize comparing it to the S&P 500 is similar? Think about this. It's similar to you going to your house and you saying, hey, am I getting this house at a good price, right? Is it a good price? And you're able to compare it not only to your neighborhood, not only to your city, but now you're able to compare it all across the country. How does your house compare to the entire country? So here, and what's very nice, if you don't know, if you scroll all the way to the right, do you see how it says as low as possible? Ideal scenario, as low as possible. So you can click on ideal scenario and you can find out, and there is so much information. I mean, so much information on this website for you to just, you want to learn and you want to know about stocks, it's all here for you. So ideal scenario, as low as possible, so it kind of gives us an answer, and it will give you the ideal scenario for all 17 of these. But this is my price divided by earnings, and it is all red, so it's bad. And we can go through all of these. I'm just going to actually, we have price to sales, price to free cash flow. So this is all under the valuation. And right now, Apple is not performing as well as all of the stocks in the same industry and in the same sector. And we can see here that it is an average stock, and we'll talk about average, good, almost good, all of those things. So this is average, and right away we can see why. Now, let's look at our growth. So when we look at growth, we can see sales most recent quarter. So these are my sales most recent quarter. So my sales, you're going to invest in a company. Do you want their sales to be really high or really low? What do you think you want? Really high. So this number we want as high as possible. And if we look over right here, ideal scenario, it tells us as high as possible. So 21.37, and the industry is 1.65, so it's doing far better than the industry. The sector is 5.25, and the S&P 500 is 1.58. So Apple is far outperforming sales. So if you've ever wondered, and I'm a big Apple fan, by the way, and I have a lot of Apple. I have an Apple Watch and an iPad and a phone and a laptop. But if you've ever wondered if you're paying a little too much for your Apple products, you are, okay? Just so you know. You can see their sales. I'm not the only one. Their sales are really high. So this is the most recent quarter. And here's why this is important. I want to know if I'm going to buy a stock, how is it most recently done with their sales, which is short term, right? So this website gives us all of this. It tells us what is the short term for sales. Then underneath that, I have the trailing 12 months. So that's midterm. So it's been doing good short term, but how has it been doing midterm? What's been happening most recent? Long term, the last 12 months. So we can see here, 5.1, it's outperforming the industry, the sector, and the S&P 500, so it's doing great there. And then, and that's what's beautiful about this website, we always go one step further, right? One step further. So how is it doing over the last 5 years? So now I want to know if I'm going to put my money, now this is my retirement, this is what I'm living off of, this is what I've worked hard for. If I'm going to invest in a company, not only do I want to know how it's done right now, last quarter, I want to know how it's done for the last 12 months. Is it still up? And I want to know how it's done, for 5 years. So short-term, mid-term, long-term, what are we looking at? So that is our sales. How is our sales growth rate? So what's it projected to do in the next 5 years? Now, understand with sales, we looked at the most recent quarter, right? And we're comparing it to the exact same quarter 1 year ago. The only way to know if sales are good, okay, the only way that I can know if sales are good is through comparison. So I'm looking at Apple, I'm comparing it to the industry, the sector, and the S&P 500, but when I look at that quarter, how do I know if it's a good quarter? I have to compare it, not to the previous quarter, because I want apples to apples. I want to know how it's done with the exact same quarter 1 year ago. All right, and especially if you think of retail, there's no way you could compare first quarter to fourth quarter in a retail environment. It just wouldn't be accurate, right? So with all of this, we're comparing to the exact same time frame. Sales, the last 12 months compared to the last 12 months 1 year ago. And what's it projected to do over the next 5 years? So now when I evaluate something, I'm saying, hey, how are the sales right now? Are they still growing from from a quarter a year ago, the last year? How are they doing overall, and what are they projected to do? Next, we're going to look at EPS. Now, what is EPS? EPS is earnings per share, okay? So let me ask you, is price or sales different than earnings? Are those different? All right, let me give you an example. When I moved to Florida, our furniture was coming up. I was driving with my daughter. We're driving around. She's driving. I'm in there. We are driving down the street. Wasn't familiar with it, but I see a bunch of balloons. I see all this stuff outside. And then I see this big sign that says, come on in, free lunch, cotton candy. And the cotton candy, I think it was hot dogs. I'm okay with hot dogs. Cotton candy, you got me there. All right. So I'm like, pull in, let's go. We go in, it's a furniture store. They're having their big 100th anniversary sale, whatever it is. And we're just kind of walking around. I've got my cotton candy and we're kind of going around. There's popcorn, everything is going. And we see this couch, and this couch was unreal, okay? Not only did it recline, not only did it massage you, not only did it have outlets, but the upper part, the lumbar part had different sections as well and different positions. And I was like, this is amazing. Salesperson's talking to me. I'm like, no, furniture's coming. She's like, well, is your whole house going to be furnished? I was like, well, there is an extra, rec room, and I don't know. And she's like, well, this is a great sale. And I said, I didn't bring my purse. I don't have my credit card. She's like, no worries. You can buy this right now and don't make any payment for 6 months, and it's interest-free for 3 years. I was like, what? Okay. I'm like, but I don't have, no worries. We can look here. So anyway, bottom line is, I bought the sectional. Okay, I did buy it. But here's my question for you. They made a sale. Did they collect on the sale? No. Do you know car companies are doing it all the time now? Come in, drive away, interest-free, no payment, especially with COVID and everything that's been going on, right? You're seeing a lot of companies get really innovative. So it looks really good on the books, but we want to know the bottom line. We want to know not only their sales, I want to know how much money they're making. So that's where the earnings come in. What are the earnings per share on their sales? So I've got quarter versus quarter, the most recent quarter, the trailing 12 months, and the 5-year growth rate. So once again, we always go, because you can go on to Yahoo Finance and you can, and they might tell you the earnings per share. You can find that. Now, they're not going to tell you what that is or the PE ratio. They'll tell you the PE ratio, but they're not going to tell you what the industry is or what the sector is. Well, if they're only giving you a piece of the information, how do you know if it's good? We go with this website, we go one step further because, the most brilliant mind said, hey, what do all the people in the industry, what did they look at? Let's bring it all on one place. So everything's right here. So yes, we've got the most recent quarter, the trailing 12 months, and the 5-year growth rate. So we're going to look at that, and we can see here that the 5-year growth rate for sales outperformed the industry and the sector, it outperformed, the industry, not the sector or the S&P 500, but the earnings per share has outperformed the industry, the sector, and the entire S&P 500. So it's done really, really well. So that's great. Next, and I know that this is a little long and it can be a little boring. The coolest thing about this whole thing, though, you guys, is that because it's all numbers, it's automated. So do you know how I looked at this and I said, oh, this is an average stock. I know right away it's average. I can go through and I just want to walk through and show you so you understand what they mean. You can take the time to go back and do further research and look at the ideal scenarios and click on them and find out what they all mean. But I want to give you an overall comprehension because this is how do I know if this is a stock I even want to buy? And then once I know the quality of the stock, I can then learn, okay, now I know about timing. It is a stock. Is this a stock where now would be a good time to buy? So that's where we're at here. So hang with me. Out of the entire 2 days, this is the most boring. But we're going to get through it. So is everyone doing okay? Go ahead, give me a thumbs up or type in okay. I just need to know you're staying with me. I'm trying to be as entertaining and energetic as I can because I know this is all numbers. And believe me, I am not a numbers person. All right. Surprise earnings and estimates. So here we go. So what we have here is our every quarter, so your stock company, so when you think of your surprise earnings, your earnings are like your report card on the company. So every publicly traded company must by law release their earnings. How have they been doing? Have they been making money? Have they been losing money? We're putting our money into it. We have a right to know. So they release that, every single quarter. So here we can see now when we think of earnings, let's just think, what do you guys think? Do we want the earnings to be high or do we want the earnings to be low? Go ahead and type in your answers. What do you guys think? High or low, logically. So once again, learning how to invest in the market, it's just different, but we can if we follow the rules, and we're going to give you a set of rules, if we follow the rules consistently, we're probably going to do okay. So these are all some of the rules and guidelines that we're going to follow as we make trades. So here we can see how did we do on earnings. Our earnings were 19.15. Well, is that good or bad? I don't know. When I look at the industry did 40. Now, is 19 above or below 40? It's below. So notice it is in red. Okay, so that's how it did in the industry. What about the sector, right? How did it do compared to the sector? Well, the sector was 22. 19, of course, is below 22. So once again, its earnings, Apple's earnings are below the industry and the sector. And then let's look at the S&P 500. Well, it did outperform the S&P 500. So that was the most recent quarter. And then we can look here and see what about the quarter before. So now I not only want to know what did it do last quarter, but what's it trending? What did it do the quarter before? Quarter before was 5.8. That was far below. So 2 quarters ago, it was even worse, right? So it's gotten a little higher, but it's still underperforming the industry, the sector, and in this case, even the S&P 500. And then what is this year's projected growth? What is it projected to do? So not only what is it doing, what are we anticipating it to do? Because everyone will analyze a stock, and you'll have analysts come in and they're saying, what do we think this stock is going to do? How do we think it's going to perform this year? and it's projected to do 27.03. Now remember, we want these numbers as high as possible. It's earnings. So if there's earnings, there's sales, we want those numbers up as high as possible. And how has the industry done? 44 is what the industry is projected to do. So it's not looking like it will outperform that. The sector, it is outperforming, and the S&P 500. So that's green. That's a little good. And next year's earnings, so what's it going to do next year? 11. So that's bad. And it is underperforming both the industry and the sectors. What it's projected to do, it will do better than the S&P 500. So what am I looking at here? I'm looking at not only my sales, right? Not only my earnings, but I'm also looking at how has it been performing? What's it projected to do? What are the analysts projecting that it's going to do? And there's a lot of red in there. So now we're going to look at financial strength. And for financial strength, what I'm trying to find out is, so this is a good one, and this is interesting. So what I'm trying to find out right now with my financial strength is how is the company managing all of their money? What is the MRQ? So my MRQ is telling me that if this company from this day forward had no more sales were coming in, not at all. How solvent is this company, and how long could it stay in business? How long could it pay all its bills? How long could it pay its employees? How long could it pay its insurance? How long could the company survive if all sales ended tomorrow? And this is telling me that it could survive 1.16 years, so a little over a year. Now, when you think about that, we want that number obviously as high as possible. So if we scroll to the right, we want it as high as possible. Why do we want that high? Because let's just say, well, think about COVID. COVID happened. How many companies went out of business because of COVID? Because all of a sudden sales, we had the whole country shut down. A lot of companies went over. Companies that were solvent, that had a lot of money in the bank, they were still able to pay their bills. If you lost your job tomorrow, no income, but guess what? You still had to pay the mortgage. You still had to pay your lights. You still had to pay your car insurance. You still had to pay your health insurance. You still had to put food on the table. How long could you survive with no more income? So that's what that tells us, and that's really an important number to look at. And then, of course, we have our total debt. We want, and they don't have a ton of debt, we want that number to be as low as possible. And you can see that even though, so with the MRQ, Apple has not outperformed the industry, the sector, or the S&P 500, so it's all red there, and that's not good. Now we have our management effectiveness, and we want that to be how are they reinvesting the money as high as possible. And they are doing actually quite well. And you can see that it does quite a bit more than the industry, the sector, and the S&P 500. So that 19.14 is a really good number. And then this is the biggie right here. Net profit margin. It is the most important. So the second most important is PE ratio, which is at the top. And then the most important is net profit margin, which is at the bottom. So what does that tell us? That tells us how much money they're making off every dollar. So right here, we know that for every dollar Apple brings in, it makes 21 cents. 21 cents. Now, you know, I worked in retail. I worked at Nordstrom's, and this was years ago when I first learned this education. And I remember working there, and one of the owners telling me, Judy, we just want to make 5 cents off every dollar. And that was good. So 21 cents is phenomenal, you guys. It is phenomenal. So once again, I said, are Apple products, expensive? The answer is yes. Are they overpriced? Well, yeah, they're making a pretty penny, okay? 21 cents off every dollar, they're doing pretty good. All right, so that is the 17 criteria. And really, it's really boring, but I wanted you to understand it because as you start making money in the stock market, you're going to talk to people, and you want to just sound like you know what you're talking about a little bit. The PE ratio, most people don't even know what that is. They don't know it's price divided by earnings. They don't have any idea. So I just want you to sound, you know, like, hey, I know. It doesn't matter. because this is all automated. So we don't have to worry about this. And really, when you look at a stock, you just go over to the stock professor, and the stock professor tells you if it's a good stock, bad stock, average stock. So this, again, is all automated for us. So now, if we go underneath that, we have a little bit more here. We have our average daily volume. And this tells us how many shares are traded a day. And this is 103 million shares. 103 million. Now, this is an important number simply because you want to at least, so you can write this down, you want a minimum of 100,000 shares traded, but ideally you'd like to see 1 million shares traded on a stock before you get into it. Because if it does not have that, then the institutions can't trade it. And that's where we're really getting into this, because here's the reality. You and me and all of us are about 5% of what moves the market. It's the big institutions that actually move the market. And what am I talking about? I'm talking about hedge funds, mutual funds, investment banks, insurance companies, pension funds. All of those things are what move the market. Now, mutual funds will be trading $1 billion, okay, $1 billion. So they might say, guess what? I want to buy a stock. I'm going to go in and I'm going to buy 300 million shares. Well, if a stock is only trading 100,000 shares, they can't do it. And even if it's trading 103 million, they can't buy 300 million shares in one day. It would just shoot the price up. So what do? They slowly buy it. They just do, 50,000 shares, 25,000 shares, 20,000 shares, 80,000. So it will actually take an institution about 3 months to fully get into a position in a stock. And if they want to get out, it takes them about 3 months to get out of a stock. They can't do it all at once. The stock would plummet. They would lose their money. So we know the beauty for us is when we want to buy a stock, how long does it take us to get in? 1 second. We can get right in. And if we know how to read a chart, and that's why I keep talking about technical analysis, because that's where you really make your money. But if we can identify when the institutions are getting in, guess what? We can get in the very next day. And as that stock goes up, we're going up with it. So that is where volume becomes so important, because you and I, we're not going to move the stock. It's the institutions. And they're not going to trade a stock unless it has at least 1 million shares. They're not going to. And really what institutions do is bring stability to a stock, because if it's a small stock and it's just you or I, well, if it's only trading 100,000 shares and I just bought 20,000 and I pull out, then all of a sudden that stock plummets. So we like to trade stocks, the institutions. That's kind of our safety. Now, underneath here, so we've got total volume, average daily volume. That's important. That's why it's there. And then we have our current Zacks score. So now what is this? Zacks is a third-party company that actually rates stocks. And really, it's just their opinion. It's not facts. It's not based on anything. It's just really their opinion. And they're actually paid, so I don't even know if it's really unbiased. They have one is a buy, a strong buy. 2 is a buy. 3 is a hold. 4 is a strong sell. No, what is 4?
Moderate sell.
Moderate sell. 4 is a moderate sell, and 5 is a sell. And you can say I don't pay a lot of attention to it because it doesn't make sense. Because quite frankly, how do you moderately sell a stock? Like, what does that even mean, right? Really, if they were really good, they would just have buy and sell. Because what does hold mean? When you think about that, what does that mean? That means it's not going anywhere, but don't get rid of it. You're not going to lose money. You're not going to make money. Why are you investing your money? To make money. This is the third part of your life. This is your retirement. You've worked really hard for this, so you want to make sure that your money is making money. So those are the 5 scores, but it's just an outside opinion. As a matter of fact, if you watch the movie The Big Short, great movie. It really gets into the market. There's a scene in there where the guy comes in and he's talking to a woman that ranks stocks. and he's talking about, I think, bonds or something. He's like, why are you ranking those good quality when you know they're bad? And her response is unbelievable. She says, well, if we don't, then the companies won't hire us. They'll just go to another company that will rank them good. So my point is they're not unbiased, all right? So that is there, though. And then we have the next one. And this tells us, it's an estimate, next earnings date, report date. Now, why would this be here? What's this for? Remember, earnings is our report card. Right? How are we doing? Now, it says estimate. As it gets closer, it'll give us an exact date. But here's why that becomes important. If I'm thinking about buying a stock, the earnings can create great movement in the stock. What if, for example, you know how I said earnings, it showed us earnings, and the analyst said, we think the earnings are going to come in here. So if the analysts project how much they're going to make, let's say they say, we think the earnings, they're going to make 12 cents, and they only make 11 cents. Do you know that will actually affect the stock dramatically? The stock could really plummet. So earnings can cause, when earnings come out, it's like the news. They could have great shifts in the stock. So if you're getting ready to buy a stock, and we have, as part of our homework, and you're going to all get homework today, by the way, and Stacy is a pretty hard teacher. She's going to be hard on your homework tomorrow, but I'm going to get you ready, so you're going to be fine. But a lot of our students will email us and say, hey, we just did this stock, because in some of our other education courses we teach, we stay in touch with our students, and we're going through trades with them and whatnot. And they'll say, we just looked at this, I'm thinking of buying this. And a coach will write back, hey, did you notice earnings are coming out tomorrow? If you're getting ready to buy a stock and you see earnings, you're going to want to hold off any kind of trade, because earnings can dramatically move that stock. Now, if you own the stock, you might pay attention to it if you just own it as this is news or what's happening in the stock, but you wouldn't want to get into a trade with earnings right around the corner. You'd want to wait for that, because it can dramatically affect that price. All right, so that's why that becomes important. And then, so we've got 1, 2, 3, and then 4. Is this optionable? And the answer on this one is yes. Now, out of all 4 of these, this is the most important. Is it optionable? Why do you think that is? Why is that the most important? Because I can do all my research. Okay, I can look at a stock, I can do everything right, research, the fundamentals are good, it's in an uptrend, it's undervalued, everything looks perfect. I can even write it out. I can say, I'm going to buy this stock, if it does this, I'm going to do this, it's going to go up, I'm going to sell here, I'm going to have a whole plan, right? I get into my trade. And then bad news comes out and the whole market falls. Or bad news for that company comes about. Or that industry comes out. And the next thing you know, I bought this, I placed a trade thinking it was going to go up, and all of a sudden it crashes. So now what do? Sell? No, if I sell, I'd lose my money. I don't want to do that. That would be stupid. I don't want to do that. I don't want to sell. So what do? Well, with my education, I can actually see the beauty of options is that options allows you to fix and repair a bad trade. That's what it allows you to do. If I want to fix a trade, repair a trade, I can either hedge it with a futures contract or with some kind of an option. But what I can do is I can say, guess what? I bought this stock. I thought it was going to go up. And now, guess what? It went down. So what I can do is I can wrap another trade around it. I can do an options trade. And I can change the trajectory of the trade. So it was making money as it goes up. I'm not even going to sell that stock, but I'm going to wrap another trade around it so that, guess what? It now makes money as the stock goes down. And now I've made money and the stock changed direction, but I can only do it if it's optionable. It's the only way I can do that. So I need, now, there's some other classes for that, but it's something you're going to want to learn, because the reason that we are hired by the Chicago Mercantile Exchange, why are we hired to make all the courses for Business Week, all of their educational courses, all of the educational courses for CNBC, every single stock market course they have, we created. Why do they hire us? Because we specialize in one thing. And what is that thing? How to fix and repair a bad trade. You know, and that's really part of your education, because your education ultimately has 3 pillars. You know, the first is learning how to trade, and that's kind of what we're getting into now. I need to learn how to trade. Pillar number 2, I need to learn how to read a chart, because if I can see what a stock is about to do, what is the stock going to do before it happens? It's like driving a car. If I'm driving a car and then I see, oh, this car in front of me is about to pull out, you know what? Now I slow down. I start to put my brakes because I can see that. Without technicals, I'm literally driving blindfolded. I don't know what the stock is about to do. So we're gonna get into, you know, technicals. Now I'm gonna teach you just enough on your technicals for everything that you need for your covered calls, all right? But learn as much as you can about technicals, because you can never learn too much about how to read a chart. The more you learn, the more money you'll make, all right? So that's our second, is how to read a chart. And then our third pillar is how to fix and repair a bad trade. I mean, we're going to be wrong sometimes. We cannot control what the market is going to do, but what we can control is our education and how we respond and how we're able to repair that. So learn as much as you can on technical analysis and how to fix and repair a bad trade. But you can't do that unless it's optional. So that's why that is so important. It's got to be optional. So now, if we come up here, we're going to see right here that fair value that I talked about. So what this tells us is if we can buy this stock at or below this price, we're buying it at a discount. We're buying it wholesale. Okay, so we're not overpaying for the stock. So the fair value of this stock is $56.70. And what is Apple trading at right now? Wow, that is way overvalued, way overvalued. And you know, when we look at our 17 criteria, we saw right away in that first one, the valuation, that it was way overvalued. Now, we can go through each one of these like we did, but really there's no need. I just wanted you to understand it and kind of talk through it with you. You can do more research if you want on ideal scenario, but all I want to do is I want to see lots of green. So we can see that this stock is rated average. So we have 4 ratings. We have good stock, and when it's a good stock, he's smiling and it's green. Okay, we have almost good stock, and almost good stock would be like a B stock. Still very good stock, great stock to buy. It's not the best of the best, but it's still good. It's still doing good in earnings, valuation, all of that. And he'll be green and almost smiling. Then we have average stock, where it's blue and he's not smiling. And then we have bad stock, and bad stock is red. So there's 4 ratings. This is an average stock, and it's average because, you know, it's pretty mixed. We can see red and green. Now, is Apple a good company? Yeah, it is. But here's the question. Is there better places you could put your money to grow it right now, right? Is there better places? So let's go ahead and take a look at a couple of your stocks. So does anyone have any other stocks you want me to look at? We're just going to kind of go through and evaluate them very quickly. And this is really fast. I took a lot of time. I want you to go through it, but let's just go through and look at any other stocks. So
Intel, INTC.
let's look at Intel. If we look at Intel, and you know, for safety purposes, you may get logged out. And by the way, when you first log in, you can see you're going to just have trading tools. We have some other classes too, but you'll have this box right here, trading tool website. And then right up here in the left-hand corner is where I can go ahead and type in my ticker symbol. And here we have Intel. And Intel is what is it going to be? Almost good stock. So that's great. We can see there's just a little red over there in the earnings, but it's an almost good stock. So that's a good one. That's great. What else do we have?
Microsoft. MSFT.
And Microsoft is, how is it going to do? It is a good stock. And you know what's really nice about this is everybody is going to give you stock tips, right? They're all going to tell you to do this stock or do this stock or this is great stock. Do you realize right now, just in a second, right, you have the ability, if someone says, hey, I want you, or your broker says, hey, let's get into this stock, you can go in and you can type in and in a moment say, hey, this is a good stock. This is an average stock. You now can do that. And you would be amazed at how many average stocks they talk about on TV, right? Just how many people will recommend average stocks. And you can say, no, this isn't or is a good stock. All right, what's another one we can look at?
EA.
EXPI. Oh, that's Expo. Let's go back to EXPI. And it is X World Holdings. And it is a good stock. Wow, you guys have some good ones. That's nice. Well, this is great. This is fun. Okay, what else do we have? Disney. How is Disney doing with COVID? Let's see if it's doing its comeback. We're here in Florida, so looks like they're doing pretty.
Closing some stores.
Yeah, some part. Oh, bad stock, right? So yeah, COVID has affected a lot of companies. So yeah, there is a ton of red. There's a ton of red on that page. So, the valuation, the growth, the earnings, all of that. So this is a bad stock right now. And let's look at another one. We'll look at two more.
Visa,
Visa. How is Visa doing? Visa is, what do you guys think? Good or bad? Good or bad? Good or bad? Good or bad? No. Bad. Okay. And look at that. Wow, that's a sea of red, isn't it? That's a lot of red. Okay, so Visa's not good. And, all right, one more. BH. All right. So, but this is nice. You guys are going to spend a lot of time going home and looking at all your stocks, and you actually are at home, aren't you? Okay, VH. We are at, oh, it is a holding company. Yeah, so it's a holding company, so it's not going to be evaluated that way. So we can still look at NFLX. Wait. There we go. NFLX, Netflix. And Netflix is an average stock. Okay, so it's average. So we can see that it's mixed. I mean, there's a lot of red, there's a lot of green. Its valuation is high, so let's look at that. Its fair value is 173, right? That's the fair value, Warren Buffett's calculation, fair value. And it's currently trading at 516. So it's average, but it's way overvalued. So what if we wanted to find some good stocks? What would be an easy way to find some good stocks? Yes.
You show them how to find a symbol.
Yeah, symbol lookup.
Oh yeah, symbol lookup. If you don't know what so let's say I worked at Nordstrom's. Let's say I just want to find Nordstrom's, right? And I don't know their ticker symbol. I can hit symbol lookup and then just type in the company and hit search right here. Boom. So I hit search, and then I immediately see that ticker symbol pops right up. JWN for John Nordstrom's. Click on that. Actually, here, let's go back. Do that again. Symbol lookup. Here's my symbol lookup. Search for the name. Type in the name. And to the right of that, I have search. And then it will pop up. Why did it not pop up here? Oh, because I typed in the name incorrectly. Here we go, Nordstrom. There we go. And symbol lookup. And there's John W. Nordstrom. So once I have that, I can simply type in John W. Nordstrom, JWN. And there's Nordstrom. And Nordstrom is probably a bad stock, but let's just see. Bad stock. It's pretty much all red, so that's not a good one.
Love their stores on website.
Yeah, okay. So if we wanted to, so that's how we look at a stock. That's how we do a symbol lookup. Now, here's the question. If I want to evaluate and I want to put my money in a stock, how do I find a good quality stock? A stock that that has really good solid fundamentals. And once I find that, then we're going to get into technicals and say, okay, when do I enter in? What am I looking for to enter? But the first is first. I want a good quality stock. I don't want a stock that's losing money. I don't want a stock where the earnings are going down. I don't want a stock that has a lot of debt. I don't want a stock that has bad management. So wouldn't it be cool if there was a way to, instead of just getting names and thinking of stocks and typing and seeing, if there was a way for me to just find all of the stocks in the entire stock market, over 3,000, and I could find all the stocks that were strong fundamentally? That would be so cool. And it would be super cool if I could do it super quick. And guess what? Because this website was made by an investor who trades for a living, it's done, and everything there is to place a trade quickly. So let me show you this wonderful feature. If we go right up here to the top, which is Scanner, and I click on Scanner, I have all of these different searches. But I can come right down here to good stocks or undervalued stocks, any one of these, and click on this, and immediately I have all the stocks that are undervalued that have strong fundamentals. And so then I'm just going to come right over here to the right-hand side and say, okay, here I've got an undervalued stock. I want one that's in an uptrend because this is going to give me a 3-month chart, right? So I already know. And what's nice is right at the top here, do you see what this says? This is telling me what my criteria is for my search. So right away I say good and almost good stocks. So A and B plus stocks, A and B plus, that are trading below their fair market value. So these are all the stocks. And how long did that take us? So really, I want you to understand that what this is equivalent to, think about this. This is equivalent to doing an MLS search and saying, what are all the houses in the entire country that are actually selling for sale at like a short sale price, a wholesale price, but really good quality homes? How long would that take? Could you even do that? That might take you years. Like to go through every single house, it would never be done. But we've done that in a matter of seconds with the scanner. In a matter of seconds. Now you know, boom, guess what? These are all the stocks that are under their fair values. I'm buying them at a discount, and they are really good quality. So guess what? I'm going to come right over here and say, okay, well, this one's in kind of an uptrend here, and I can just come over here and say, oh, wow, look at this, Morgan Stanley, MS. Let me just pull that up, and I can see right here, wow, why would I put my money in, I could buy Apple, right? Kind of going sideways, but look at this. It's just in a really strong uptrend, and look at all that green, and it's good quality. And right now it is $80.87, and the fair market value is $95. So guess what? I'm getting it at a discount. I like that, right? If I'm going to buy something and it's just giving me now, understand when I buy something like this, that doesn't mean, oh, the stock is going to go booming. It just means I'm getting it for a good price. I'm not overpaying for it. I'm buying it at a good discounted price, right? And that's just one. If we go back and look at, I just want you to really understand the power of this because there's so much here. So we've got Morgan Stanley, and then I can look here. We've got RF, Regions Financial. We look at this one. This one pops up. It's in a strong uptrend. We're going to get into trend next. And look at that. There's another good stock. This one is, the fair market value is $23, and it is trading at $20. There's another one. And if we look, you guys, there's stock after stock, page after page. I mean, we can go all the way down. We've got over 5 pages for you to look at. So why are you going to waste time? Because remember, what is the only reason that you are trading? The only reason you put money? What is the only reason that you buy a stock? What's the only reason? Think about it. To make money. It's not like you are emotionally tied to these companies. It's not like, oh, no, I really want to own Apple. I don't want to own Morgan Stanley. I love Apple. I like their products, but I don't care. I'm not concerned about their stock. I want a stock that makes me money. I'm not going to bed at night with the ticker symbol of Apple under my pillow saying, I really love this ticker symbol. No, I want to put my money, the third part of my life, my retirement, in stocks that are going to make me money. That is the purpose. So now, and I've mentioned there's several different types of trades that we can do, so we have all of that. But as we go through this, so that's kind of our fundamental analysis. So we've gone through all of that. And then we have next what we're going to be doing. So we've got the stock search. So I just showed you how to do that. And really what we're doing is there's many searches there. You have the good stock, the almost good stock, there's the undervalued search. So there's a lot of searches. And also we have, we'll get into the 3 green arrow search as I go through and teach you how to read a chart and when to get in, which is my favorite. So our next section is my favorite. Now, understand that all of you are going to have different styles of trading. I trade typically, I do weekly and monthly trades. I'm a little more conservative. Stacy is really conservative as she's managing money because she manages high net worth people and does really safe conservative trades there. But in her own accounts, she's a little more aggressive. Now, Lori, she's a grandmother. And actually, let me introduce you to our coaches. So you have Lori, and Lori lives in Seattle, and it's interesting. I want you to understand that all of these coaches, and these coaches are completely complimentary for you, but a lot of you are going to have questions on what type of account to open, how to move things around. That's what the coaches are there for. So they're going to reach out to you at this next break, but Lori lives in Seattle, Washington. She's a grandmother. She does more monthly and weekly trades. She's a little more conservative like myself. She has a background. She owned a coffee shop, and here's the cool thing. She actually got into trading when there was actually a really tough time in her family. Her daughter got cancer. And she actually knows Stacy, called Stacy up and said, I can't even think, right? I can't run my coffee shop and do this. Stacy said, you know what, Lori, just learn to trade. So she was able to do that and learn to trade and be at home as a grandmother and do all that. And that's the beauty. But now, as you learn this, when you're learning this, it's going to take a little time. But once you get this down, you're looking at, for your covered calls, you guys, 10 minutes a day. And that's just to check your positions. You can do that on your smartphone. So this is definitely a skill you want to develop. How do you learn to make your money make money? So Lori does, Lori's been trading since 2009. She loves hiking, and her and her husband travel the world. Now we also have Sandy. Sandy has been married for 7 years. She used to be a financial investment advisor and realized they didn't teach this. She was great at her job and just said, my gosh, I can't believe I didn't learn any of this, and started doing this. She's a little more aggressive. So she likes to trade a little more aggressively. She might do a trade for every 2 or 3 days. She wants to bring a paycheck in. Now, once again, you're learning covered calls. That's monthly paychecks. And as we look at that, we can look at some possible weekly ones, but there's different ways to trade. And she is very aggressive in her trading. She does a great job. It's hard to believe someone could be that beautiful and that smart, but that's Sandy. And Nora is from Dallas, Texas, and she was in the Air Force. She trades full-time with her husband. And she actually, all of our coaches, as I said, have gone through this education. That's nice for you because they're going to understand where you are and the type of questions you're going to have and what the steps are. So nobody here people don't apply. Actually, we go to them and we see how they're doing, how they're progressing, and we say to them, hey, you're doing a really good job. Do you want to share this and come work? And so we can teach other people. Brandon is from Texas as well. He trades full-time with his wife. He left a broadcasting career to trade. How fun is that? So he just loves to play in his rock band for fun and travel. And then we have Craig, and Craig lives in Orlando, so I imagine he must go to Disneyland all the time, right? But he actively trades the markets, been married for 25 years, homeschools his kids. He did work for Disney World and right now is also a director in a software company. Here's all of our coaches are phenomenal. They're all phenomenal. They're all students. They all are bringing in weekly and monthly trades. So they're going to reach out to you. If you have not been contacted by a coach, just type in the chat box and say, hey, Lori, who am I supposed to connect with? But what is nice is a lot of you have different types of accounts and you're in different places. So you're going to say, what is the best step for me? They're only here to guide you. Just what makes the most sense for me. So it is 1 o'clock and we are going to take a break and it'll be about 10 minutes. So we'll be back here at 1:05 Eastern Time. So go ahead, get some water. We're going to get into our next section, which is technical